This week, markets are gearing up for more economic data across the globe. In Japan, the economy returned to modest growth in the fourth quarter, missing expectations. Meanwhile, AI optimism is fading as investors reassess valuations, putting pressure on major tech stocks. Back at home, investors await Tuesday's labor force survey from Stats SA, with structural unemployment still a major challenge. Jamil Ahmed, chief analyst at online trading brokerage GTC, joins us now for a look into the economic week ahead. Jamil, thank you so much for your time today. Let's start over in the US. Key data that influences the Fed's monetary policy moves out. We got non-farm payrolls as well as consumer inflation over the past week. The former painting a mixed picture when it comes to the labor market's resilience, whereas the latter, yes, cooling, but still not at the Fed's 2% target. How are you making sense of it all as we look ahead to the PCE figures?
Well, I think the most concerning aspect is actually that the Bureau of Labor and Statistics continue to revise down after time what the job growth really is in the United States. And I think that might be making a few investors a bit more skeptical now about these headline NFP data readings, because it's not the first time that it's happened over the past 6 months or so that you've had a huge downward revision of actual jobs being created for the US economy, which obviously creates a bit of a misleading picture. And as you said, it's a bit mixed. But when it comes to the inflation, actually, I think that was much more market friendly, just the market's paying its attention towards other matters, whether that's Trump unpredictability with policy or some of the other geopolitical elements that's happening. But inflation coming in at 2.5%, just below that actually, it not quite a trend, but it hopefully shows that inflation is cooling, which then suggests that the Federal Reserve, US Central Bank, will be in a position to cut interest rates potentially sooner than what the market currently expects in July. And should we start to see that chorus of cheers that the Fed might cut interest rates even before Jerome Powell is set to leave his position as Fed chair in a couple of months, that would be good news for emerging markets. I think it'd be good news for financial market stability, and also be promising news for those currencies that have been battered by the persistently strong greenback over the past couple of years, although the US dollar did fall to a 4-week low about 2 weeks ago, a 4-year low, apologies.
And we'll get into that emerging market story in a bit. I want to just get your sense of how concerned you are when it comes to that AI threat, right? It seems like we're heading into a sort of structural shift, if it's not already happening, particularly when it comes to jobs where we're seeing white-collar jobs being or suggested that it will be replaced by AI. We've already seen Amazon cut thousands of jobs over the past year.
For the real economy, of course, automatization will be a problem for the real economy because we are talking about real people jobs. When it comes to financial markets, I don't buy into that idea at all that the last week's sell-off and profit taking was because of concerns over real jobs, because we all know shareholder value is only there to see more profitability. And that's what AI is destined to bring in the same way that technology did over the past decade or so. So I don't think that's the reason why financial markets were selling off at the end of last week. I think that's far more to do with a bit of uncertainty when it comes to when the Fed might pull the trigger on further interest rate cuts in 2026 and how many there might be. Also, I think policy uncertainty when it comes to Trump administration as a whole. You never know what's going to happen next, and you don't know what's going to happen over the weekend either. So I just think investors are taking profit on positions. But so far, any trade this week seems to be a bit more calm.
And sticking with, financial markets and what we've been seeing play out over the past few weeks ago, it seems like sentiment has shifted from, when it comes to the AI boom in particular, has shifted from the winners to the losers. We saw the software stocks under pressure. Last week, we saw the financial stocks taking strain. I'm asking myself what sector is next. But Jamil, are things not being over-exaggerated at this point?
They are being over-exaggerated because you have to take into account that, look, what's happened in financial markets, we talk about gold and what happened with that $5,600 and that's huge profit taking, what's happened to crypto, silver and so forth. And even the financial markets, we're looking at a correction, not a crisis.
Okay.
There's no crisis happening in the world economy, and I think that investors are just taking profits from positions. And you do have some successes out there. For example, what's happened with McDonald's stock hit a 52-week high only past couple of trading sessions. Of course, if there is going to be a crisis in the economy, it seems that people still have money to eat at McDonald's, and that seems to be okay.
You're absolutely right. Just looking, or rather thinking of those McDonald's numbers and some of those consumer staple companies that were out with numbers over the past few weeks. You mentioned their emerging markets, and it seems like we are, of course, benefiting from the weaker dollar, as well as that rotation out of some of those US counters filtering through to our local markets. Now, with volatility remaining the name of the game and precious metals prices where they're still at, right? Do you still think there's more room for this rally to run?
In one word, yes. And the reason for this is going to be much more around the US interest rate expectation talk, because actually I think emerging market enthusiasts had a little bit of a win just last week when it appeared to be the Treasury Secretary himself in the United States. He implied that even he will put pressure on the incoming Fed chair should he actually have that nomination approved by the Senate, but that appears to be looking like it's signed, sealed, and delivered. But even he would put pressure on the US Central Bank to keep cutting interest rates. So you no longer just have President Trump tweets in or using his social media and so forth to complain about the Fed. You even have senior officials around him. And should that inflation data begin a trend of calling inflation in the US, and should we continue to raise our eyebrows at some of these revisions when it comes to the jobs numbers, that suggests the US economy is not ticking along as resiliently as perhaps we thought it had. And that only just beats the drum that the Fed would need to cut interest rates more aggressively. And at the moment, they still have the ammunition to be cutting interest rates. And this is where it's somewhat of a catch-22 and a bit of a conflict, because if it wasn't for the White House uncertainty when it comes to the Trump administration of the past year, with the tit-for-tat tariffs and then how long those trade wars lasted with the tariff rates and so forth, the Fed would have cut interest rates much sooner and been much more aggressive. But here we are where we are anyway, and let's just see how things fold out.
Jamil, I'm getting a sense that financial markets, traders, investors are questioning the reliability and the credibility that comes with those economic prints, particularly the jobs numbers.
You are completely correct. And I also think that investors are getting a little bit fatigued of what is much more a sentiment-driven market because of the news flow constantly changing around geopolitics, Trump policy, and so forth. We're not really playing a financial market here that's going by trends or specific rallies or calm downs and so forth. You're looking at a financial market that's simply just changing and twisting as per the news flow. So it's very much sentiment driven, not driven by technicals, not driven by fundamentals. And we don't know what's going to happen over the next couple of trading days or how February might unfold.
I've been saying it's Trump's world and we just live in it, Jamil. Now, let's take a look at what's playing out in Asia. It's been a quiet day on that front with public holidays in China and South Korea, but we did get some economic data out of Japan. Of course, that country narrowly escaping a technical recession with growth expanding 0.1% from a contraction of 0.7% in the third quarter. Take me through some of the pressure points there. Are we still looking at perhaps exports, Japan being affected by some of those tariffs over the third and fourth quarter?
Somewhat, but actually I think if you look at the political situation within Japan right now, you've had the election just over a week ago, which of course was a snap election, and you also have some concerns over what might be happening in Taiwan and so forth. I think there's more to read into the data rather than the headline economic prints.
Okay.
But overall, you've got the Nikkei that continues to look very promising, and that's been the case for a long time. And you've got the Japanese yen, that's the most oversold and undervalued currency in the whole foreign exchange world, specifically for the developing markets. And in fact, if you said the South African rand had been battered and bruised over the past couple of years from depression because of how weak that as currency has been in line of emerging markets. There's no currency in the developed world, G10 and so forth, that is as bruised and battered as a Japanese yen. So I think that story will start to change. You do have the dollar JPY, which obviously the Japanese yen at about 152, 153 as we speak now, significantly below the 160 handle where it was just a couple of weeks ago. And I do think that that currency is very much primed in line for a correction.
Quickly, before I let you go, here at home, we have a few prints out, inflation, retail sales, as well as the jobs data. Let's focus on consumer inflation, right? We did see inflation tick up slightly in December, but there are expectations for inflation to continue to trend lower towards the 3% target. Are you pegging an ease when it comes to consumer prices, considering that we did see fuel prices tick lower over the month of January?
Well, there's hope that in December, inflation would peak at 3.6% at an annualized level. But the truth be told, since July last year, it has roughly ranged somewhere between 3.5% and that mid 3% handle, somewhere around 3.3%. So I don't really see where this month's figure should have a huge drop off. But where I would look is that should we start now declining and seeing actually something in that headline that hopefully inflation peaked at 3.6%. Don't get me wrong, when you've got an unemployment rate as high as in South Africa, any inflation is too high. Nonetheless, should it start dripping lower, then we will see the South African Reserve Bank head more towards interest rate cuts. And I do think the interest rate at the repo rate at 6.75% is too high for South Africa for where the economy is. It should be coming down more towards 6%, but you need somehow with that inflation pulling lower.
All right, let's leave it there. Jamil, thank you so much for your time and sharing your insights with us today. That was Jamil Ahmed, Chief Analyst at online trading brokerage GTC.